Welcome to IG's Trading the Markets podcast. I'm Jeremy Naylor. Joining me today to look at the markets is James Stanley, currency strategist at DailyFX. James, it's good to talk to you. You come to us at a time when, of course, the markets are in a little bit of a quandary as to which direction Donald Trump's going to move in next, whether it's a question of a massive delay to trade talks and a trade resolution, or it could be resolved quite quickly. Very, very divergent tweets we've heard and opinions on where the markets are going to go next. We've seen this pullback. What's your best case at the moment, having had this pullback in the equity markets, as to where things are likely to lie?
Hey, Jeremy, it's good to be on with you again. I'm a trader, so I'm generally cynical of near-term moves, largely looking for areas that I could fade off that, let's call it exuberance, or maybe the over-emotional response that we'll see on some of these things that are often driven by noise. I think in the U.S. at least, it could be parceled out based on just overall quality. I think in the S&P 500, we might have another press on the lows. I don't think that the retracement there is done yet. I mean, especially if we look at just how incredibly consistent those gains were coming in during October and November. And, you know, corporate earnings were down, Fed's cutting rates. I think the big driver there was really hopes around a trade deal. I think this is one of those scenarios where, you know, pretty much anybody that looks at the backdrop, looks at the horizon. There's a presidential election in 2020. President Trump has already exhibited multiple times over the last 3 years how he could basically move the markets at will with a tweet here or there. You know, I mean, it's nothing new for him to throw out a tweet in the morning and then markets to run on that all day. So I think the wide expectation is he's going to try to put as much air in the sails as he can going into that 2020 presidential election. So it's almost as if we know where things very well could be next October, next November. It's just a matter of how to connect one point to the other. The fact that things got so overbought coming into December, I think just a little bit of noise in that expectation profile, i.e. a delay on the Chinese trade deal, was enough to scare out some of those longs, give us a pullback, and I think it might still have some room to run before the long side of the S&P looks attractive again.
Okay, we're at 3110 at the moment. Are you talking a pullback down to what, big round number, 3,000, or is that too far in your book?
I think 3,000 is almost a little bit too clean for comfort. I mean, if we go down to 3,000, catch support, I'm looking at that for a quick run of continuation. I think that the low is going to come in a little bit higher than that. The inflection point that I'm focusing on specifically is around 3062, 3065. There was that's the early November swing low. Yep. Came in on like November 6th. I think there's probably a lot of stops that are set underneath that price. So I think if we could tag a fresh 2-month low or a fresh monthly low, I think we'll see the selling hasten for a little bit, and then that's when a level like 3026 comes into play. Yeah, 3026 was a prior swing high. It gave us a bit of support in late October. I think that would be a really comfortable level to look to keep bullish continuation, you know, firmly in view.
That is, of course, 500 stocks of the biggest companies in the States. It's a broad market index. What about something like the Russell 2000?
Yeah, very good question. So the Russell put in a very visible breakout last month, and that was, I don't want to say surprising, given that, you know, we've had these equity themes, or we've had these, you know, kind of these themes of hope permeating around U.S. equities for a while now. But the Russell 2 was a laggard throughout the year. You know, we had the Q4 sell-off last year across U.S. equities. Both the Dow, the S&P, even the NASDAQ. I mean, it clawed back all of those losses and then some. All three of those indices ran to all-time highs or fresh all-time highs. The Russell 2 still hasn't. The Russell 2 is still underneath last year's high. You know, so I think it was being looked at as, you know, kind of the weakest of the pack. You wanted to pick on weakness in U.S. equities, go for the Russell 2, go for the small caps, go for the lower credit quality names. But the breakout that came through last month, I think, was pretty telling in what we could be looking at in the months ahead. Fact is, Russell finally broke out of a range of congestion last month with some of that hope permeating the backdrop. But when we had the sell-off show up around the December open, the Russell 2 stayed pretty tame. I mean, it was a pullback to support prior resistance, whereas the S&P 500, the NASDAQ, even the Dow are putting in what looks to be more bearish types of moves. Now, that's not usually something we'll see in a major market turn, where these large cap names, these big cap names are the leaders of the turn. Usually it's going to be those smaller cap issues or those high beta issues, and that simply hasn't happened. So that's one of the reasons that I'm still looking at this from a longer term backdrop of continuation. I do think we're going to see the bid pressed going into next year. It's just a matter of what support level in the S&P is going to come into play that's going to stem those sellers.
What about the foreign exchange markets? How is this playing out with the backdrop that we've spoken with regard to the trade talks? And of course, we must be mindful of some of the rhetoric around interest rates in the States and some of the economic numbers that we've seen. What's the dollar positioning looking like going into the back end of the year?
So the dollar has been in a really strange pattern so far this year because we've seen a concerted flip at the Fed. You know, I mean, it was just last December the Fed hiked for the fourth time in 2018, and that was 9 hikes in 4 years. I mean, so I don't want to call it an aggressive hiking cycle by historical standards, but you know, considering where we were in the 5 or 6 years before, pretty aggressive. But 2019, we saw the Fed stop hiking rates, start cutting rates. We've now seen 3 rate cuts so far this year. And markets are expecting more. I mean, the 10-year dipped down to 1.7 yesterday after hitting 1.87 the week before, or the month before, excuse me. You know, so I mean, that's a notable move in a very key asset, in a very key market. So I think we are going to see some continued pressure on rates going into 2020 because, you know, if markets were basically running on hopes of a trade deal, and that trade deal is now no longer looking so likely, that's just even more reason for the Fed to come in with accommodation. And I do think we're ultimately going to see the Fed do what they've shown a pattern of doing, which is getting really super dovish whenever they see the economic backdrop deteriorating. And if we do see continued pressure on lack of hope around a U.S.-China trade deal, I think that's what's going to end up playing out, what's going to end up happening. I think there's also an X factor here, you know, because Trump has shown over the past 3 years a strong ability to be able to move markets at will. And going into that election next year, I think it's pretty widely expected that he's going to want to have equities as strong as possible as voters are going into the polls. So if there isn't a U.S.-China trade deal, what's next? I think that's where we're going to start hearing about tax cuts again coming out of the U.S., like tax cuts 2.0 or something along those lines. And I think that could take some of the tension away from the lack of a U.S.-China trade deal, and it could also give him, you know, a pretty strong case going into next year's election of saying, hey, if you want a president to fight China, I'm your guy. And by the way, I'm giving you more money in your paycheck because I just cut your taxes for this year. You know, I think that's somewhat of what we're going to see if we don't have that U.S.-China trade deal going into next year's election.
So you short dollars then?
Yeah, I like the dollar lower for a couple of different reasons. One is it appears as though it's just now starting to play catch up. So in the first 9 months of this year, the first 3 quarters, the dollar was relatively strong. I mean, it gained throughout that period, even as the Fed was cutting rates, you know, like I said, 3 full times. Well, the third, of course, came in Q4, but they were lining it up coming into October. But even with 3 full Fed rate cuts, the dollar continued to strengthen. And it built into what's called a rising wedge pattern. Rising wedge patterns are real interesting for bearish reversals because we're usually seeing a pretty vigorous response from buyers at the lows, much more tame response from buyers at the highs or near resistance. And if it was a legitimate bullish trend, buyers should be a little bit more aggressive at resistance or at new highs. And when they're not, when they are tepid, when there is a bit of trepidation in that step, that's usually something that's going to end up playing out. That's what happened in the open of Q4. October saw a bearish move in the U.S. dollar. USD dropped through the bottom of that rising wedge formation. November put that at a bit of a pause. First half of November saw a quick rally, 50% retracement, but a real key zone of resistance held the highs in USD. And so as we open the door into December, again, sellers are coming back. It looks like those lows from November are going to get pressed. And I like the dollar lower going into and through next year.
Yeah, so which currencies should we be most actively selling the dollar against?
Well, the British pound's breaking out like there's no tomorrow. I think the big challenge there is going to be just given current backdrop, point of entry, because fresh breakouts are tough to chase, especially one like we've had in the British pound where it takes out a huge psychological level and just continues to run, continues to rally. I mean, if I'm lining it up at this point, I got to take on like 200 pips of risk, and I mean, it's hard to project another 200 pips of gain. The risk reward scenario there just is not attractive at this point. So I need a bit of a pullback. $4 weakness next year, I think euro dollar starts to look pretty attractive, because I don't know if the ECB has any more ammunition to go any lower, to go any weaker. Combine that with Christine Lagarde and the fact that it really looks as though she's going to try to use her political prowess to maybe align some of these economic issues through the Eurozone. And the Fed simply has lower to go than the ECB, more room to cut, more room to get accommodative, and that's something that I think could add another spring in the step on the long side of the euro, euro dollar specifically going into next year.
With a weaker dollar, quite often comes good news for commodity markets. They're priced in dollars, and I know that you've got some interesting thoughts on gold going into 2020.
Absolutely. So that for me has been kind of the big takeaway from 2019 so far. We saw, around this pivot, this flip at the Fed that's basically taken place over the last year and 2 months. We've seen some pretty incredible moves in gold. And I think this is one of those things that kind of highlights, maybe the lack of recent memory across a lot of market participants, because, a lot of traders are stuck on short-term charts, hourly, 4-hour, and it can be easy to lose track of the big picture. But, gold prices started to set a low around August of last year. October 3rd of last year was especially important because, at that point, stocks were rallying, setting at fresh highs. The Fed had hiked recently. They were looking to hike again. And Jerome Powell, in just an offhanded comment, was asked, where do you think the neutral rate is? And he says, I think the neutral rate is a long way off, which was widely inferred to mean the Fed had plans for a lot more hikes coming into 2019, 2020. They didn't have any plans to slow down yet. But it was right after that comment was dropped that things reversed. Risk aversion showed, and I mean, peak to trough, just looking at S&P Futures, we had a 20% move in Q4 alone. But that was also right around the time that the Fed started to get more dovish, less hawkish. We started to hear, from Fed members in January, February, we don't have to hike. We're not committed to anything here, guys. We can slow down, we can pause, and that's what we saw in March. But the Fed wasn't super dovish there. They were just less hawkish. It wasn't until June that the Fed started to get really dovish again. Another Jerome Powell speech where he was a bit more telling about oncoming rate cuts, which we eventually got in July. But it was right around that June move when gold prices really started to break out with reckless abandon. And I mean, it was a strong breakout that ran for almost the entirety of the summer. I mean, the high was set early September. But I think that gold theme tracks fairly well with the theme that's been taking place around the Fed, getting more dovish, more accommodative, a little bit more worried about global growth concerns, especially in light of the ongoing trade disputes. And we've just basically seen 3 months of congestion. That high was set in September. The Fed's kind of framed their current stance as a pause on policy. That rate cut that we had late October. Powell basically implied that the Fed wasn't looking to make any moves in either direction until something significant happened. And, nothing significant has happened. Just that continued deterioration in the backdrop has kind of led to the belief that the Fed's ultimately going to have to get dovish again. Which is why we're seeing a bit more pressure on Treasury yields coming into December. And gold prices started to bounce again. So I think that the pullback that we've seen from September into current day is a corrective move that's ultimately going to bring buyers back into the equation at some point. And I think we're going to see gold prices flying through next year.
Flying very briefly past the 1550 odd level that we had in the middle of summer this year. You're quite happy about that being taken out?
Yes, sir. Yeah, I'm looking closer to like maybe 1,700 and change.
Okay. James, I'll have to leave it there, but thanks indeed for joining us for this week's IG Trading the Markets podcast.